Hello and welcome to another weekly review. My name is Grant Collins. I'm an independent economist with AIM Research. And today I want to cover the economic data that came out for the week. It was jam-packed. It's mostly jobs, as you can tell by the title, jobs, jobs, jobs. We're going to talk a lot about that, but we also got the Dallas Fed manufacturing survey data. We got productivity and unit labor cost data to cover, as well as digging into the labor turnover and the general employment report. So stick with me a little bit to cover this afternoon here, but I think a lot of it will be valuable to you. Let me start by sharing my screen and we will dig into the data today. So what I want to start with is just the Dallas Fed manufacturing survey data. If you remember, we were looking at the composite of New York, Philadelphia, and Texas. And what was interesting is New York and Philadelphia were telling completely different stories 2 months ago, and then now in this month as well. What we have seen is New York looked to be doing okay while Philadelphia continued to struggle, and those two flip-flopped where New York looked like it was struggling and Philadelphia was improving. And we've been using Texas as well as Kansas and Richmond to try to help break this confusion here. Not only is it important to look at the regional Fed survey data, but they're a great indicator to help us understand the ISM manufacturing report. The ISM manufacturing report did come out this week. It came in lower than expected. It was 47.1 on the prior week. It came in at 46.9. And just to give you an idea, we can actually look at the composite of New York, Philadelphia, and Texas, and that paints a very similar picture of what happened to ISM. So let's take a look. So here's the regional survey data of general business conditions. You can see New York, Texas, and Philadelphia here. Again, all of them mostly still heading lower, as you can tell. Let me grab a kind of a highlighter here so you can see it here in the most recent run. Here's the composite of all of them together coming in at minus 23.8. So again, still lower. Now you take out and you remove that 2015 general slowdown, and it looks much more like the 08 slowdown or even the COVID slowdown, or as some would like to call it, a recession. New orders in the ISM report really struggled, whether you looked at brand new orders or whether you looked at backlog of orders. Both of those declined in the ISM report. Composite between all three of them, you can see that after a big jump, because again, New York a couple months ago was showing a big rise in new orders, those have now been priced out and are coming back down again, minus 17.7. What about employment? We're going to look at the general employment data today as well. ISM employment pretty much held stable. Here, when you look at the regional Fed survey data from New York, Texas, and Philadelphia, again, holding somewhat stable, moving sideways here at minus 0.8. So again, not too much change in the employment side. Here's the current prices paid. I think this is the one we really have to be the most pleased with. Prices are coming down, and that's important. You can see most of that progress from Texas and Philadelphia here, less of it coming from New York, but regardless, aggregating them and compositing them together, you're seeing a directional trend lower at 19.9. This does a really good job of illustrating the PPI, why the PPI is at 2.7. and why it continues to slow down, and I expect it continue to slow down from the manufacturing side of the economy. Now, we did see last week that PCE and the inflation rate was a little bit sticky. That was further echoed by the unit labor cost data that came out. In fact, unit labor cost, let me check my notes here, came in at 4.2% compared to the 3.3% prior. The forecasted estimate was for much higher at 6%. So unit labor cost, remember, that is the cost, the input cost from the employer to create one unit of a particular good. So think in employment cost, think material cost. With the PPI coming down and the prices paid coming down, but yet wages still remaining somewhat elevated, you still have kind of a sticky unit labor cost, which also probably feeds through to somewhat sticky inflation here. So you can see that in the general composite. Let me float down to Texas here because that's the one that was reported. Minus 29.1 on the general business conditions, minus 16.1 on the new orders, 9.6 on the employment, and 13.8 on the prices paid. So to me, this continues not only looking like Texas, but also looking like the whole indicator as a whole, with New York, Philadelphia, and then even throw the ISM. They're all basically painting the same picture. Manufacturing's in a recession, but the market wasn't really surprised by that. In fact, if you look at the market data, the stock market made a new high for the new year, not a new all-time high, just a new high for the year, sitting at 4282. And that came from a couple things, right? I think it came from a stronger employment report. I think it came from a passage of the debt ceiling. And as I'm recording this today, Biden has already signed and put that into action here. And so the S&P accelerating here off of the news that the debt ceiling is behind us. Again, it's very narrow. It's tech, discretionary, and communications. But this volatility index really falling below, really low levels of volatility. Even high yield spreads, whether it's the triple B or high yield option adjusted spreads, came down a little bit over this week. And even coming down a little bit further, you saw bullish sentiment pick up. Remember, just a week ago, we were at 0.26. Now we're at 0.29% bullish or 29% bullish, compared to 36% bearish, where it was 39% bearish. So you really are seeing this kind of transition happen as some of this data comes through. So, it's pretty clear manufacturing still struggling. Let's translate that now into the jobs report. Now, because remember, we did get the Texas Fed survey from employment, and we also got the ISM from employment. Both of those showed really no change at all, but there was a lot of information in this week's jobs reports that I think are going to be helpful. We're going to start with the JOLTS report. Job openings and labor turnover data. Surprisingly, labor job openings actually accelerated a little bit, and you can see that in the chart here, as you're seeing a small increase here from a month-over-month perspective. This was not expected. I think everybody expected the general trend to hold and for it to continue to drag lower. That's also what the Federal Reserve wanted as well, right? You're going to notice that this jobs report makes the Federal Reserve job that much harder whenever we get into the Fed meeting here in a couple weeks. Here's the quits rate. The quits rate still holding, pretty elevated, but 2.4%. Again, peaking late in 2021, 2022, and still declining. So to me, quits rates coming down also shows signs of a slowing labor market. Think about it intuitively. If someone is willing and able to quit their job because they can move on and go get another job somewhere else, that means that the labor market is really beneficial for the worker. But if the quits rate's coming down, that's now shifting maybe some of this back into the hands of the employer here, with the quits rates dropping a little bit. Hires also kind of flatlining here. Hiring rate has come down quite a bit, but still basically staying about the same at about 6.1 million. Layoffs, we're not seeing a huge increase in layoffs. This looks really similar to the initial jobless claims numbers that we've been seeing, where it has been rising, but it's not, all out recessionary. I'm really watching this level. I think if you get above 2 million, I think that's cause for some concern here, but we're just not there yet. So keep looking at that, keep watching that here. Other separations, so think of like retirements, that's up a little bit, about 330,000 people, pretty good increase there on the retirement side of things. Here's this ratio that Jerome Powell loves, job openings relative to the unemployed worker. It's still pretty close to 2 at 1.8. It actually went up a little bit. The trend is still directionally lower, right? And I think that's important to note. Why does Jerome Powell look at this? I think we talked about this the last time. It tracks really well with employment cost index. So the fact that the ECI is headed lower at the same time at this job openings, unemployment worker is heading lower. Those are going to continue to probably move together. And again, I think it's a stark comparison between who holds the cards in this labor market. Is it the worker or is it the employer? I'll show you one more chart here, or two more, I'm sorry, of labor supply and labor demand. If you use payrolls and job openings together, it looks much tighter than if you use the unemployment level and job openings. If you use the unemployment level and job openings compared to the labor force, you see that labor demand is still outpacing labor supply. Now, why is that the case? Well, as you're going to find out from the employment report, it's because labor force participation rate and employment to population ratio are still struggling to recover to pre-COVID levels. In fact, the labor force participation rate is setting at 62.6, which is exactly where it was in the prior month, and the employment to population ratio is setting at 60.3. Both of those still have a ways to go before they have recovered. Let's just kind of draw this line here for both of them. Now, that may not be the straightest line in the world, but you can definitely see where they were pre-COVID versus where they are now, and why you're seeing this big divide here, this big gap between labor demand and labor supply. So again, at least from the JOLTS data, it still shows a relatively healthy labor market. That's important for us to think about because, again, here in a couple of weeks, after another CPI report, the Fed is going to have to make another interest rate decision. And you've got some that are, volleying and vying for a pause and allowing for more of the data to come in. And you've got others that are saying, look, things are still looking pretty red hot. We should go ahead and hike another 25 basis points or another 1/4%. Let me show you the employment data, and let's come to some consensus when we look at the Federal Reserve data here. So you can definitely see that the employment cycle continues to drive higher. 339,000 jobs were added in this sector. In this month. We'll talk about the sectors here individually. Let's square this with the ADP report. The ADP employment report also came in pretty strong as well. Just real quickly, the ADP, let me find it again. I just had it. Came in at 278,000 compared to the 296,000 prior. The estimate, however, was for 170,000. The estimate on the total non-farm payrolls was for 235,000. So almost 100,000 difference between what actually got reported versus what everybody was expecting. So where did all of this strength come from? Well, first and foremost, I want to point out that even though we are still, growing right on trend, it is weakening some, and this has been my call for a while, that the labor market is in this kind of maturing state where it was so hard to get these workers that I don't think we're going to quite lay them off just yet. But some leading indicators like the initial jobless claims and the hours worked are slowing down. And I think that's important because it's easier to cut hours worked before you move into that full layoff phase. And you're going to see that here in just a second. Let's keep moving down here. The unemployment rate did tick a little bit higher because we didn't see the labor force participation rate pick up like we did in a couple prior reports. It is still well below the non-cyclical rate, or what we call the natural rate of unemployment, which is setting at about 4.4%. It's all the way down here at 3.7. So you can see that we are in this full employment status. Let's keep coming down here and look at some of the other numbers. Average hourly earnings came in really good. Another 0.3% month over month increase. And so what that actually looks like here from a trend perspective is still pretty much higher from a general level perspective, but you can see when you get into the cycle that it is also slowing down as well. Let's square that with the average work week at 34.3 hours. You can see that that has peaked almost around the same time that the job openings and labor turnover, that ratio that Powell is looking at. Let's go back up for a second here. This ratio, they both kind of peaked right around the same time here and have been coming down ever since. So very much negative on a cycle perspective when we look at weekly hours, not average hourly. This is weekly hours of work. I'll have to fix that later. So again, it looks a lot like the 2008 recession, looks a lot like COVID, and less like this general slowdown in 2015, right? And it's because we're through this line that I'm looking at right here. So we'll see. This is definitely a concerning side that the work week isn't holding. This is, again, probably why the cycle of the labor market in general, this payroll report, is rolling over. Not negative yet, but certainly losing momentum. Let's keep coming down here. Here's our paycheck proxy. So essentially just multiplying the weekly hours worked multiplied by the average hourly earnings, and then multiplying it for, and trying to get a yearly salary out of it. Right now, that's about $57,000 a year. That is also below trend, as you can see here, and heading lower as well. Let's look at it as an aggregate income. So if we take this same proxy and multiply it by the total non-farm payrolls, you're going to get the general aggregated income for the economy. And again, that looks to be slowing down a little bit here and also heading lower. And so I think, again, all of this points to a labor market that's in the late cycle, that's slowing down. And let's take a look at the individual sectors, and you can probably see more of this slowing. Here's the mining and lodging. We talked about this in the last month, that this is where a lot of the hiring was taking place, and you can still see it, that it is well above trend. Doesn't look to show any signs of slowing down here for mining and metalling. Construction is kind of rolling over and softening here. But again, from a trend or just from a general level perspective, it still looks really good. Manufacturing, definitely flatlining. And that squares really well with the manufacturing report from the Fed survey data and from the ISM manufacturing survey. You can see that it's about 2 below trend and pretty sharply negative here. Let's keep going here. Professional and business services looks to be flatlining, and it's also gone negative as well. That's come down pretty hard. Leisure and hospitality, this was where a lot of the jobs were added in the ADP report. Looks like quite a bit of jobs added here as well. Still looking really good on a general level perspective, but slowing down some here. Utilities, trade, transportation, again, looks to be flatlining there, coming straight down. Private education and health services, this was a bright spot in the prior month. It's a bright spot in this one as well. As you can see that it's still above trend, still accelerating on a cycle perspective. So again, just 2 sectors right now, minings and metals, and then private education and health services seem to be the only 2 that are still accelerating. Information, slowing down, coming down pretty markedly there. Government, that was another bright spot here, above trend and still accelerating on hiring there. If the government's going to be cutting expenditures now that the debt ceiling's behind us and they only have a 1% cap on spending, and they're going to reevaluate it again in 2025, I would imagine the employment cycle for the government's probably going to slow down as well. So really only 3, one more, financial activities. We know this one's a little bit weaker as well because of the banking slowdown or the banking crisis that could be taking place here. So just 3 sectors that are showing jobs added. The rest of them are showing, kind of some flatlining or some rolling over. So to me, even though this payroll report did show a really strong number, we need to look at revisions to this number over the next little bit. We know revisions are important because they can definitely change the initial reading that we're looking at here. I'm looking at this and saying, when we look at the JOLTS data and we continue to see the demand for labor outpacing the supply, we see the labor force participation rate not improving, and then we move forward and saying, look, we're still adding jobs, but the fact that productivity is still very, very low. So for instance, we also got the productivity reading. It came out at minus 2.1% quarter over quarter compared to the prior at 1.6. So despite the fact that we have all of these jobs, they're not being more productive. If they're not being more productive, we're not out, our output's not growing. If our output's not growing, the economy's not growing. And so this is really where I'm looking at this and saying, look, I see this as a labor market that's cooling, even though what we're trying to do here is, trying to bring this supply back up again and try to entice these people back into the labor force. Well, I don't think that's going to be the case. I think the demand is just going to cool off, because if the economy continues to cool, there may not be a need for these workers, or it may continue to just be very, very narrow. It may just be narrow in the leisure and hospitality space. It may be very narrow in the metal and mining, maybe very narrow in the private education and health services. And then the rest of the manufacturing or the housing side of the economy may continue to slow on their hiring. We'll see. We'll see how that progresses here, but that's my general take right now. Now, what does that mean for the Fed, though? Because last week you got a sticky inflation report. This week, you now have an employment report that showed some really promising signs, even though it is slowing. I would argue that it's still tight, whether you look at the job openings, whether you look at just the headline number. Again, this points to a very difficult decision that the Fed has to make here. Do they raise rates and stay tunnel visioned on the inflation problem? Or do they kind of pause here and say, look, we need some more information. We've done a lot of tightening. We're already restrictive. Let's see what happens next. My general consensus here is that they should pause on the rate hiking before they move into doing anything further. They are going to get another inflation report before they have to actually give us their interest rate decision. But I think they can pause and just allow balance sheet runoff in the background. Let me show you why I think that. If we come down to the ample reserve regime and we just look at just the total level of reserves in the system right now at just a touch over $3.3 trillion. Well, if you compare that to where the Fed believes there is what they call a floor in reserves, they want to always operate in an environment where reserves are plentiful. They don't want to operate in an environment where reserves are scarce. They feel like that puts a lot more pressure on the financial system, and they want to keep that stability. And also having more reserves allows them to set interest rates better. It allows them to make sure that short-term rate doesn't move throughout their range, which again, that range is up here. You can see just briefly here, let me draw this out here and here, which is basically 5.25 right now. That's the range. And so the Fed funds trades within this band. If they have a lot of reserves, they can actually control that band even better. What you're seeing here from where they are versus the two estimates that I have, one is from the Fed themselves. They think the floor of ample reserves could be 8% of GDP. That's roughly $2.1 trillion. My estimate is currency in circulation, which tracks the GDP estimate pretty well at 2.3 trillion. Either way, you have about $1 trillion plus of available reserve balances that you could continue to run down to the floor. Now, what does that mean? Well, that should give the Fed the ability to pause on their rate hiking side, but continue to do quantitative tightening in the background. Why is that important? Well, we know quantitative tightening, depending on past journal articles and research that's been done before, that it could be the equivalent of 1 to 2 interest rate increases. So 0.25% additional increases. Couple that with the senior loan officer survey that said, look, they're tightening lending standards, credit conditions. They're basically saying that we don't want to lend as much in this environment. Well, that's another form of tightening as well, which could also be another 1 or 2 rate hikes attached on top of that as well. So to me, it makes a ton of sense here to just pause and maybe accelerate your balance sheet runoff. Maybe instead of saying, that we're going to do, 25 basis points at each additional hike, maybe instead of doing 95 billion a month, we do 125 billion a month. And we scale that up so that acts as another form of tightening, but you remove that interest rate uncertainty. Again, I'm not the Fed. That's just what I would do here in this environment. I think that acknowledges the banking crisis. It acknowledges the tightening and the slowdown that's already happened. And it also allows the inflation progress that you've already seen. It allows that to continue to process on from here. And so will they do that? It's not likely. It seems like the CME Fed tool that you can go and look at have a high probability of a 25% rate hike. I believe when I looked on Friday, it was about a 60% chance that they were going to go ahead and raise interest rates here at the June meeting. We'll see if the CME tool is right or if I'm right here. But I do think that there's enough evidence or enough information here where they can actually pause. That's why our title here this week is Jobs, Jobs, Jobs. What will the Fed do? To me, it's a very sticky situation because you had a sticky inflation, last week. Now you've got a pretty good jobs report that shows that, yeah, on balance, things are slowing down, but they're not falling apart. So, Fed, it's your turn, it's your move. in this giant chess game that we're playing, it definitely makes for a difficult move for the Fed here. So stick with us. We'll see what they do. I think this week's information hopefully was helpful for you. Please leave a comment, give me a like, subscribe if you like this information. We want to continue to provide you something that will help you through your investing journey and help you through navigating this economic landscape. But again, we'll be back next week for another update. Next week is pretty light. I believe we have the ISM non-manufacturing survey. So seeing the service side, that should continue to hopefully perform well, because if the service side starts to weaken, then that starts to really lengthen or really give credibility to the recession calls that are out there right now. Again, that's not our base case. We think the demand in the economy has slowed now for 12 or 13 months or so. It started slowing in 2021, and that slowing has been that recession, as now we're below trend on a growth rate perspective. And now as prices come down enough, I think there's going to be some people that were on the sidelines waiting to do some projects. I think there's going to be some reacceleration here, which may be why you have some stickiness in the inflation rate. Could be why the consumption from the GDP revision was still looking pretty good here. What else are you going to get? You're going to get imports and exports in the balance of trade. You're going to get used car prices, and then you're going to end the week with more job claims, jobless claims, and mortgage applications to end the week as well. So light week next week on economic data, but at least this week was all about the job. So again, hopefully this helped you. Please leave a comment. If you have any questions, I'll be happy to answer those for you. Like and subscribe if you like these videos, and we'll be back again next week with another update.